The CEO of America's largest bank just sold $150 million of his own company's stock. Jamie Dimon. JPMorgan Chase. October 2024. This is a man who, in 17 years as CEO, had never sold a single share. Not during the 2008 financial crisis, not during COVID, not during any of the market crashes that made other executives cash out. For 17 years, he held every share. Then, in 1 month, he dumps $150 million. The official statement said it was for financial diversification and tax planning. Financial diversification. The man runs a $3.2 trillion bank. Tax planning. He's worth $2 billion. You don't need to diversify when you have $2 billion. You don't need tax planning that requires selling $150 million in a single month. But before we go further, pause this video. Write in the comments, what time is it where you are? And do you think bank CEOs sell stock randomly, or do they know something? Let me show you what Jamie Dimon knows that you don't, and why the timing of this sale tells you everything about what's coming. Dimon sold at $206 per share. JPMorgan stock had just hit an all-time high. The S&P 500 was near record levels. The media was calling it a Goldilocks economy. Perfect conditions, soft landing, no recession. That's what they told you. That's not what the data showed. In the same month Dimon sold, JPMorgan's own research division published a report. The probability of a U.S. recession in 2025, 45%. The probability of a market correction of 20% or more, 60%. These aren't external analyst predictions. This is JPMorgan's internal research. The same research Dimon reads every morning. He sold at the top of a market his own bank said had a 60% chance of dropping 20%. Here's what makes this different. Dimon doesn't trade. He holds. His entire reputation is built on long-term thinking, on staying in the market through volatility. When he sells, it's not trading, it's positioning. And he's positioning for something big. Now let's talk about what Jamie Dimon sees in the banking system itself. Because he's not just selling stock, he's looking at the balance sheet of every major bank in America. And the numbers should terrify you. Commercial real estate. $2.9 trillion in outstanding loans across U.S. banks. Office buildings are empty. Remote work destroyed demand. Office vacancy rates in major cities. San Francisco 36%, Houston 28%, New York 22%. These buildings can't cover their debt payments. The loans are coming due, and they can't be refinanced. Here's the mechanism. A building worth $100 million in 2019 took out an $80 million loan at 3% interest. That loan comes due in 2024 or 2025. Now the building is worth $60 million. Vacancy is 30%. The loan needs to be refinanced at 7% interest rates. The math doesn't work. The owner can't make the payments. The building defaults. The bank takes the loss. JPMorgan holds $87 billion in commercial real estate loans. Bank of America holds $42 billion. Wells Fargo holds $138 billion. These aren't small regional banks. These are the systemically important institutions, too big to fail. In 2024, $929 billion in commercial real estate loans mature. In 2025, another $786 billion comes due. That's $1.7 trillion in loans that need to be refinanced at double or triple the interest rate into buildings worth 30% less than when the loans were made. Small banks have already started failing. First Republic collapsed in March 2023. Silicon Valley Bank collapsed the same month. Signature Bank followed days later. The FDIC took them over. The assets were sold. The losses were absorbed. But those were $200 billion banks. When a $3 trillion bank has problems, there is no FDIC solution. There's a bailout. And Dimon knows the bailout is coming. He's not selling because JPMorgan will fail. He's selling because JPMorgan will survive by absorbing the banks that don't. and he wants cash when the buying opportunity arrives. This pattern has happened before. Every time, the same people profit. Every time, they know in advance. Let me show you the exact playbook. October 2007. Goldman Sachs CEO Lloyd Blankfein sold $27 million in company stock. The official reason? Estate planning. 3 months later, Bear Stearns collapsed. 6 months later, Lehman Brothers filed for bankruptcy. The financial crisis destroyed $16 trillion in household wealth. Blankfein sold at $230 per share. By March 2009, Goldman traded at $47. He timed it perfectly. But here's what nobody talks about. Blankfein didn't just sell his own stock. Goldman Sachs was simultaneously betting against the same mortgage securities they were selling to clients. Internal emails called the products junk and crap. They sold them anyway. Then they shorted them. They made $3.7 billion betting against securities they told clients to buy. The SEC fined them $550 million. Goldman paid it without admitting wrongdoing. The fine was 15% of what they made. The cost of doing business. September 1929. Joseph Kennedy, father of JFK, pulled all his money out of the stock market. He'd been trading on margin, making millions on the boom. Then he stopped. He told friends the market was overheated. 1 month later, Black Tuesday. The Dow fell 89% over 3 years. Kennedy kept his fortune. He bought assets at the bottom, real estate, businesses, Hollywood studios. He turned $4 million into $180 million during the Depression. The pattern is always the same. Insiders don't announce they're leaving. They don't hold press conferences. They file the required paperwork and cash out quietly. They diversify, they plan, they position. And 6 months later, everyone else loses everything. Dimon sold in October 2024. He filed the paperwork in July. He executed in October at peak prices. He's already positioned. The question isn't whether something is coming. The question is when. Here's where the pattern repeats. And here's who's profiting right now. Jamie Dimon isn't the only one selling. Jeff Bezos sold $8.5 billion in Amazon stock in February 2024. Mark Zuckerberg sold $428 million in Meta stock in November 2023. Leon Black, Apollo Global Management, sold $172 million in March 2024. Warren Buffett, the man who tells everyone to hold forever, sold $10.5 billion of Bank of America stock between July and September 2024. He cut his stake by 23%. Bank of America, the second largest bank in America. These aren't diversification moves. This is coordinated positioning. When the people who built the companies start selling, they know something you don't. Look at what they're buying instead. Buffett is holding $325 billion in cash. That's 28% of Berkshire Hathaway's entire portfolio sitting in treasury bills. He's not waiting for a dip. He's waiting for a collapse. Cash positions this large mean he expects to buy assets at 50 cents on the dollar, maybe 30 cents. JPMorgan isn't just sitting on Dimon's sale. The bank increased loan loss reserves by $1.8 billion in Q3 2024. Reserves are money set aside for loans that will default. You don't increase reserves by $1.8 billion unless you expect defaults. Big ones. Soon. Goldman Sachs cut 3,200 jobs in January 2024. Morgan Stanley cut 3,000. These banks don't fire revenue-generating employees unless revenue is about to disappear. They're cutting before the crash, not after. That's how you know they see it coming. The Federal Reserve sees it too. They held rates at 5.5% for over a year, the highest rates in 23 years. They know high rates will break something. That's the point. They raise rates until something breaks. Then they cut rates and buy the assets. Every cycle works the same way. Raise rates, break the system, buy at the bottom. It's not a bug. It's the design. Dimon sold at the top. He's waiting with cash. The crash is coming. And he'll buy back in when JPMorgan stock hits $100. This brings us to what's happening right now and what it means for you. The mechanism is already in motion. You just can't see it yet. Commercial real estate defaults started in Q4 2023. They accelerated in 2024. By Q3 2024, delinquency rates on office properties hit 9.3%, the highest since 2013. Regional banks hold 70% of all commercial real estate loans. These aren't JPMorgan and Bank of America. These are New York Community Bancorp, Valley National Bank, Western Alliance, banks with $50 billion in assets. When they fail, the FDIC steps in. But the FDIC Insurance Fund has $128 billion. Total commercial real estate loans at risk, over $1 trillion. The math doesn't work. Here's what comes next. More regional banks fail in 2025. The FDIC runs out of money. Congress authorizes an emergency fund. Taxpayer money, again. The big banks buy the failed banks for pennies. JPMorgan, Bank of America, Wells Fargo. They absorb the deposits. They write off the bad loans. They consolidate power. Jamie Dimon's JPMorgan gets bigger, and he buys back his stock at half the price he sold it for. You've seen this before. 2008. The government bailed out the banks. The banks foreclosed on homeowners. 10 million families lost their homes. Bank executives kept their bonuses. Nobody went to jail. The big banks got bigger. The 5 largest banks controlled 35% of all U.S. banking assets in 2007. By 2023, they controlled 48%. Every crisis makes them stronger. Dimon knows this. He's done it before. In 2008, JPMorgan bought Bear Stearns for $2 per share, a bank that traded at $170 1 year earlier. They bought Washington Mutual for $1.9 billion. WAMU had $307 billion in assets. JPMorgan paid less than 1% of the value. The government guaranteed the losses. JPMorgan took the profits. That's why he sold $150 million in October 2024, not because JPMorgan is in danger, because everyone else is. And when the collapse comes, he'll be standing there with cash, ready to buy everything at liquidation prices. The crash isn't coming for him. It's coming for you. He's just making sure he profits from it.